Welcome to Centaur Financial Services Podcast. The information provided on and made available through this video and podcast does not constitute as financial product advice. The information is of a general nature only and does not take into account your individual objectives, financial situation or needs. It should not be used, relied upon, or treated as a substitute for specific professional advice. We recommend that you obtain your own independent professional advice before making any decision in relation to your particular requirements or circumstances.
Hi everyone, welcome to our monthly investment committee update. Today we've got Bobby Byrne along with myself, Hugh Robertson, and we're just going to jump straight in. We're very excited, which is a little bit sad in a way, but the inflation data literally came out about 10 minutes ago, and year on year, at the end of the June quarter, inflation has gone down now to 6%. To March 22-23, it was 7%. So this is a real positive for us. So what does that mean? So we're now looking at inflation's down. We're excited, but what does that mean to our clients out there?
Yeah, right. So obviously a percentage point drop over the quarter is quite significant.
Massive.
Inflation is essentially all to do with kind of what we're doing with interest rates in the economy slowing or speeding up, essentially. So the kind of second derivative consequence, if inflation comes down, it kind of people thinking that interest rates won't have to go as high to suppress the growth of the economy, which means, the economy generally won't slow as quickly, which is good for investment markets, broadly speaking. So investment markets are up today in Australia.
So we couldn't help ourselves. As soon as we saw the inflation data, we had to jump onto the ASX 200 to see what that had done. And a massive spike was up 0.2% in 5 minutes. So what that means is also the markets are seeing that as a very good sign that interest rates are probably near peaking, if not peaked, near peaking. Again, we'll find out within the next month some more data. But currently the cash rate is at 4.10%.
Yep.
The consensus was it might go to 4.35, but that may change now with the inflation data that's gone down so rapidly.
Yeah, I suppose looking at that, the inflation data is obviously one of the key points they look at when they're making interest rate decisions, because we can't have things getting 6% more expensive every year. It's just not sustainable. So that's why they increase interest rates to slow that growth. But the other thing we need to look at is the unemployment rate.
Yes.
Because that's still at a historical low, about 3.6%, which means that more people are in jobs, growing the economy quicker, which kind of also spurs on inflation. So that's another thing we need to keep an eye on, not just the inflation.
So we think that, and we've said this a couple of times now, we think that ultimately inflation goes back up to a more normal level. It does mean that some people lose their jobs. However, it's overall better for the economy. And some of those jobs might have been created during COVID when they weren't necessarily really sustainable jobs. They were just created during that time where there was a lot of free money in the system and people were spending more money and then grew their businesses, put more staff on.
So we're kind of coming back off that sugar high, so to speak. So with that, just building on that a little bit, the last kind of decade, we haven't really had inflation in the system. We had to try very hard to get inflation, couldn't do it. But now it's back. It kind of brings interest rates back up to a normal level. So investment markets are actually probably operating more normal than they normally would for the next 10 years potentially, because now we have interest rates back in the system, which means the tools that we have to move the economy will start to work again a bit more. Because if we're at 0.1% interest rates, you can't really go much lower than that without going properly negative. So that's kind of good moving forward. It means portfolio theory, all the fundamentals start to work as they should again, really.
And in normal times too, so from an investment perspective, in normal times, fundamentals matter a lot more. And with interest rates historically low for a decade, it gave the opportunity for investments that might not be there on their own merit to go up in value. We've always said to everyone we're worried about unlisted assets, unlisted debt, unlisted credit, unlisted property, things of that nature. When rates were really low, they could get away with not being the most efficient investment assets and not being transparent and not marking their values to market prices. And it didn't really matter because there was always liquidity to be able to sell. We're now seeing a lot of issues coming. If you guys just read the Financial Review or even just watch some of the media of late, you're seeing a lot of these unlisted assets, people not being able to get their money if they want to get 25% out or 10% out of their fund. They can't do it right now. So some of the things that we've I suppose, been overly cautious about the last decade is coming home to roost now as to maybe the reason why we didn't ever put it in our clients' portfolios. So it's very careful because people are typically attracted to that for the yield. But now we can get yield from other places. So we don't really need to go in those things where we see that there's smoke. There quite possibly could be fire. There might not be, but there could be. So we're just steering clear of those. So what are some of the options now in terms of, for the clients, we've got a higher inflation environment, but cash rates are back. What are we doing from an investment committee perspective in terms of looking for managers to put in portfolios?
Yeah, so I suppose firstly, from a high level, an asset allocation level, the ball game's kind of changed. Now interest rates are back in the system, as I kind of said before. So in terms of equities is one part, but we also look at fixed income as well. So fixed income is kind of a function of interest rates. Essentially, if the interest rates are high, it generally means the new bonds being issued in the fixed income realm can generate a higher income, which is good for everyone. And now interest rates are starting to get towards their peak. It actually makes that more appealing kind of asset class, because there's also risk that if interest rates keep going higher, those fixed income instruments can also have a bit of trouble. So now we're near the peak, higher interest from them, which is good because that's your defensive part of the portfolio. So that can buffer out the returns from your equities as well. So I think that's something we're really starting to look at from a broad asset allocation perspective.
So we're now getting much better income in the fixed interest space. And this is the whole past performance is not an indicator of future performance piece, where a lot of clients are going to look at bond funds over the past 10 years and they're not going to look great because that's a virtue of the fact that interest rates were so low. You weren't going to get a high yield. Now, when the facts change, our view should change. Interest rates globally have all gone up, especially in the developed countries. So, the US interest rates are high, Australian interest rates are high. So we're looking now at a position where don't look at what it's done the last 10 years, don't look at what's done the last 5 years. You are going to get a good yield on fixed interest right now, which you haven't had probably for the past 15 years. There's also, we talk about this black swan event that happened last year. So let's quickly touch on that as well, as to if you normally hold shares, bonds are a really good diversifier. Yep. What does that mean?
Yeah, so essentially the way they usually act in a normal environment is they have a slight kind of negative correlation, meaning if equities kind of go up broadly, bonds might go down a little bit, or they don't necessarily move in the same way. But last year, in the first half of 22, they did move together. They were positively correlated. So shares went down, bonds went down, which we haven't really seen before, or at least for a long time.
I think it's happened 4 times in history and only once by more than 10% in both asset classes.
There you go. So it's not something we see often. So your bonds is your defense. And last year, the defense let us down. Black swan event. So now interest rates are back. It kind of makes bonds function a little bit more normally. So we've got more confidence there as well. Plus the yield is back. So it makes a bit more sense from an asset allocation perspective. Is there anything else we're kind of thinking investment community wise?
Well, I think, lots of thoughts. It's the implementation that we've got to make sure we're assessing. But to go back to that first half of last year, the US shares were down 10%, US bonds were down 10%. We get through to December, January, and still things aren't looking good. Things aren't looking promising. We're struggling still. We read the outlooks, and nothing's all that positive. And then we've had the last 6 months where the share market, in particular the US share market, has gone through the roof. And, the surging 7 stocks have gone up. I think we looked at the NASDAQ around 34%. Was that a 1-year number?
I think that was over the 12-month period.
So we're starting to see that this diversification really makes sense, because last year it wouldn't have been surprised if people wanted to get out of US shares with negative performance.
Yeah,
they would have said quite rightly, we don't like it, but the whole measurement of 1 year as a performance metric is just false. Don't use that as your line in the sand. Make sure we're looking underlying at the quality of the investments, making sure it's allocated, to different asset classes so that we're being prudent. You've really got to write it out, because we're now looking at the mid-year outlooks that have come out just in the past week or two, and they're all quite bullish on the future. So, 6 months ago, they weren't bullish, and then we had the really good share market lift. 6 months forward, they're now saying it's going to be great. So again, the crystal ball's broken. We never know what's going to happen. and that's why we always diversify. So another thing that we are looking at is we see that the Western world has done quite good in the recovery. It feels like interest rates have gone up, now inflation's coming down. What's going on with places like China and India?
Yeah, China, big story for us because they're our major kind of trade partner. Obviously, what they do impacts us quite heavily. So they're kind of in the opposite situation to what we're doing in the developed market world in terms of their economy looks like it's slowing. So they're thinking they might need to stimulate. I think announcements come out recently where they're saying, yep, we might actually stimulate, which generally has been good for Australia because that means they need to import more resources and minerals that we produce, which boosts our economy. So if we kind of see China starting to go that way, that could have tailwinds for our share market in particular, which is made up of a lot of resource companies, such as the top 10.
Yes.
So yeah, it's something we're looking at now as well, which could be a good driving factor for Australia going forward.
And quite possibly that could help us avoid a recession.
Yeah, I guess the kind of money that comes in from that goes towards our GDP figures. So technical recession is 2 quarters of negative GDP growth. So if we can avoid that, recession avoided, happy days.
So, okay, so we're trying to keep these things to 10 minutes. They're nice and brief for our clients out there because we can talk about this stuff all day.
True.
So let's try and quickly wrap it up and make contact with us if you want more information. But so let's go with America first. It seems like it's been pretty good. We're in the middle of a reporting season now. 80% of the earnings have been on the upside, which is a positive.
Yep.
This is in contrast to we had a US debt ceiling that was going to, the America was going to default on its debt. We had a US banking crisis at the start of the year. So even despite all that noise, US is still doing okay.
Yep.
Australian share market looks pretty good. Return in the 9s for the last 12 months, which is good. But we've seen, banks have done okay in the last week or so. So resources might do good on the back of China.
Stuff.
So we're okay there. Property, we haven't really touched on that. We might save that for another day.
It's
but
a whole thing.
We're treading water with that. We're not overly optimistic or bullish on that.
Yeah, agreed.
Our cash, we're getting a great rate of return on at the minute. Still, even if we're getting 4.1% or 5%, it's not keeping pace with inflation at 6%.
Yep.
So we still know that cash isn't a viable long-term answer. And fixed interest probably is our most exciting. It seems bad to say it, but it's probably our most exciting asset class is fixed interest. And we feel with high-quality investments there, people will be able to get a good diversifier away from share market risk, a really good yield that they haven't been able to get for 10 years. And maybe even if interest rates peak and then start to go down, they might even get some capital growth out of that.
Yeah, that's it. So you kind of putting yourself more towards the upside than the other downside, I think, with the fixed interest. So that's something that we're talking about a lot at the moment.
So there might not be quite as much fear as there was 6 months ago.
Yes, I'd probably say that's accurate. Considering the reports we've been reading at each interim, things are looking more bullish, but I think we're still proceeding with caution. Make sure we're in quality investments, well diversified, just the fundamental principles. Sticking to those, I think that's the way forward.
And I feel I suppose the last message for our clients is that we definitely are being more defensive than usual in our approach, even with the investment strategies that we've been able to uncover in the past 12 months. They've got downside protection.
Yeah.
So if the market's highly volatile like it was a year and a half ago, 2 years ago, they shouldn't experience the same level of volatility, as other people will, if they're invested not in the way that we are invested. And the way that we are allocating capital is there for, number one, a good yield, but also for protection if there is what we call an economic winter.
Yeah.
Any final thoughts?
I think that pretty well wraps it up. We'll keep doing the work in the background, updating you, of course. Let's see what we have to come in the next 6 to 12 months.
There you have it, guys. Thank you very much for your time today. I hope you found it useful. Reach out to us if there's any other questions and we can incorporate that into another one of these quick videos. All right. Thank you. Bye.